Good morning, ladies and gentlemen. As usual, let us very quickly review what happened this week, starting with the shortest end of the curve in the US, i.e. the euro dollars. Well, overall, there was a very marginal improvement of about 3 basis points on the week. We are still in a downtrend in the front euro dollar month. The 2-year note reflects it absolutely. On the daily basis, we've just basically gone sideways all week and consolidated. The same can be said of the fives and the tens as well. We just basically went up, down, all week and basically finished very slightly higher than when we started the week. But we maintained the positive bias, it seems. We tried, these were the levels that we said that we will be covering shorts to reset higher up. The move happened more or less as we thought it would, and now we are in no man's land, thinking that we are actually waiting for Wednesday, and we will see in a second why. The 30-year note basically just annoyed us. It did 99% of what we thought it would do after the auctions, but stopped us out before going back to where we thought it would trade. August markets designed to annoy the hell out of everybody. We don't think that there's anything significant here. We've been going up and down within a 3-point range for the past, well, feels like forever, but certainly 2 to 3 weeks. The market is coiling, and at some stage it will decide on the next move. We certainly wouldn't fade a break to new highs until we get the new highs, and we certainly don't want to buy it at this level to own for the long term. We just think it's far too expensive on a hedge basis. In other currencies, the yield is now zero. So we feel that there is very little upside in this. Certainly, can it go to 176, 177 back to the highs? Yes, of course it can. Simply because there is very little alternative to owning dollar assets at the moment. But Europeans completely on holiday, Schatz completely sideways, Bobble exactly the same. It's done absolutely nothing for the past 4 or 5 days, but it's maintaining this bullish bias in this bullish box, which is certainly not a sign of a weak market that you want to sell. Bunds, actually this 300-minute, you can see how it's maintaining every dip gets bought. So now if it starts establishing itself above 168.06, that will be a sign of a range break, and we could get positive momentum in the bunds. At the moment, we don't see it. We don't see any reason for it, but the data we will get next week might provide some clues. Certainly not a market that wishes to go down. It had many opportunities to break down below 167.50, 40.50, 30, 40.50, and go and test the bottom of the range around the 166 area. It has singularly refused to do that. And the reason is that everything else in Euroland is rallying like crazy. This is the BTP, up every day. There's a wonderful trend channel there. BTP, Spanish bonos, Portuguese bonds, you name it, it's all rallying together with gilts. Basically anything with yield in euros is getting bought. anything with a positive yield. And in that kind of environment, it's really unlikely that bonds are going to suffer much pressure. The big question is what happens once they've driven those periphery market yields down to such lows that they are no longer sustainable. But that is not something which is likely to happen during the thinnest weeks of the year. Uh, Europe is completely on holiday for the next 2 weeks until the beginning of September. So we think that this kind of slow grind up is more likely to happen than any kind of breakdown. We will be naturally aware of that, and we don't plan certainly on selling the bunds until we see a decent break of this area, which is basically the below 167, 166, 80, 90 to us is now key. And until we see a decent break of that area, we see absolutely no reason to do anything to bunds but buy the dip. Moving on to the dollar, and this is the chart of the dollar index. On the week, basically very slightly weaker than it was. Um, you might as well call it unchanged. The 9650 area remains the pivotal area. It tried it, failed, came back. We thought on Friday they would continue breaking down, because every time it's failed the 9650 area, it has very quickly gone down to the 9360 area. But it didn't, and the reason we think is that on Wednesday we are going to get the FOMC minutes. People were covering shorts ahead of that just in case the US Fed decides that they're going to use much more hawkish language. That is what we think happened on Friday. So we are still of the opinion that Wednesday will be the decisive day for the dollar index. If the language used is dovish, we think that we could see a very quick break down towards 93.63 or the start thereof. The that view is it's very supportive by every other component of the index. We have the euro in a slight uptrend. I mean, when I say slight, I mean really slight, on a dovish tone from the FOMC. People could start deciding that that is it. We probably are not going to get any more hikes, and certainly not before the presidential elections, and certainly therefore not this year. So they could take it back up towards the 113, 114 area range, which is still within this range that we established in a day a couple of months ago, and we've been trading within it for the best part of a month and a half. So all we're saying is back towards the top of the range, 113, 114. Nothing much that indicates anything that is going to change in the short term. Cable still looks like a proverbial whatever. It's every day the selling pressure is just intensifying. Every day we get more reminders of why the Bank of England is easing. There is absolutely no support for it. It just hugs this lower Bollinger line, and we are sure at some stage it will go and test the 128 area and probably spike through it and then come back, because that is the trend. Any kind of decent rally up towards 131 we will be sellers of, without a doubt. On a weekly basis, what it's done, it's opened up the Bollinger Bands through trading in time, and now we think in the next 2 or 3 weeks, certainly after Wednesday, it could come down towards the 125, 122 area. The yen is naturally doing exactly the opposite to all the other currencies, but it's very, very range bound. We've remained in a tiny range for best part of 2 weeks. We are now in a 1% range. Whether it breaks up first or not, it is marginal, but we certainly think that these lines will be tested. So at some stage you will have some sort of a crisis, and it will trade below 100. And just to make things exciting, and we think that that will be probably the last hurrah. If we can get it between the 95 and 97 area, that is going to be very interesting for us. Why do we say that? We've been looking at these weeklies, and this is the point that we are looking for. We're looking between 96 and 98. Huge area of congestion where there were. This is the end of the basically of the third wave, so we think that any kind of support towards the 95 area is going to be a very, very interesting level to establish longs for a swing back up towards the 105 area at some stage. That is what we're looking for at the moment. Naturally it'll change as things evolve, but that is the area that we're looking for, and we think over the course of the next couple of months that will happen. The one market which is tempering our potential bearishness for the dollar is the gold market. It keeps on failing at this trend line, and we think it might be ready to break down towards the certainly towards the lower end of this range, around the 1300, just below 1290. Certainly after that it remains, unless it can take out the higher levels of this trend line, it remains vulnerable to a fall towards the 1200 area, which could be very, very rapid. Which actually brings us to our favorite short, which is the Aussie dollar. The Aussie dollar on the dailies has been in this kind of channel for the past 7-8 months. We now feel that it's beginning to roll over. And as you know, we've been bearish of it for quite some time, but we think it's potentially ready to start a move back down towards the 73.80 level, which would be towards the bottom of this trend channel and the 200-day moving average support. That was on the dailies. On the weeklies, we get much the same picture. We've failed at this resistance, and we have the possibility, we've made a bit of a doji here, and we have certainly the possibility to trade down into the 73s, or very low 74s before any kind of meaningful bounce. And that could very well happen next week. We will look in a moment at the calendar of events, and we will see why that could easily happen. The Aussie is now at a very, very critical level. This is a beautiful channel that's held it since since late July. We closed on Friday, right at the lows, right on this trend line. We feel that if it trades sideways for Monday, Tuesday, there is a real potential for it to come down towards the middle of the week, and that move could be very quick. It could trade down from the high 76s to the low 75s, mid 74s, literally in a day and a half. If it starts breaking down, do not stand in its way. Jump on the trend. When the Aussie gets moving, it gets moving very, very, very fast. US equities. Well, what can you say about US equities? Exactly what we've been saying for the past several weeks. It is hugely overbought on all reasonable time frames, i.e., dailies, weeklies, even monthlies. But it keeps on grinding higher. I think this week we had a, what was it, four handle move, net net. It's doing exactly what we think it was going to do, i.e., just grind. And at the end of the day, if you're long of this, you're taking risk for no reward. Still, much better to be short of volatility than be long of the market, if that is what you want to be. The uh, the picture is exactly the same in all the indicators. It is the same in the Nasdaq. It is now up 1, 2, 3, 4, 5, 6, 7 weeks on the trot, just hugging or breaking slightly the top of the weekly Bollinger Bands. The same picture is in the monthlies. This kind of run comes to an end at some stage. We've had, I mean, if you look at this run, 1, 2, 3, 4, 5, 6, 7, 8 weeks, and then a 2-3% consolidation range, and then it moves again. We suspect much the same thing is going to happen here. It's going to frustrate the hell out of everybody. All dips down towards 4,700 in the Nasdaq we suspect are going to get bought, as any dip into the 2130s and 40s in ES is going to get bought. We would have thought that these moving averages will slowly start getting to those levels. So any dip down towards the previous highs, 2135, 2140, is definitely going to be an area where a lot of money gets put to work. Retests of highs are common. People like to buy them. So in this kind of low volatility environment, we really don't see much potential for a lot lower prices. Nothing has changed this week. The volatility ratios are still hugely overbought. They're telling you that if you buy here, the risk reward is certainly not there. This is the chart of the cash VIX, i.e. the index. As you can see, it is in a very tight range. This is a daily chart. It is still not below the levels that it achieved back in July of last year. In July 2014. So we do still have some room for it to come down. The VIX is hugely oversold. On the other hand, there is absolutely no reason to buy it that we can see. If we ever see a retracement of this move, which we let's hope we do see it in the next couple of weeks for whatever reason, towards the 44.5 area, and the 0.382 comes in at just below 50, we will be heavy sellers of that area. It To us, it's inconceivable that the VXX does anything but fall, and the real reason is the shape of the curve. As you can see here, don't forget that Wednesday we have front month expiry, i.e. the August VIX goes off the board, and then the VXX will actually be long of these two. Well, you have the index trading below 12, and you have the combination of the front 2 months after Wednesday trading at a melded rate of approximately 16%. That's a 5% convergence move. That is massive. So we feel that at some stage, and hopefully after a pop, the VXX is going to get absolutely destroyed and make new lows. So we are hoping for that, and that is all that can be said about volatility. The ones that are much more positive are the DAX. The DAX has, for the first time, managed to break and hold, for the first time in 2016, break and hold this massive resistance area around the 10,500 area. And what's more importantly, it's broken the downtrend line. That should give us a trade at around 11,000 at some stage. What we are saying is that dips in DAX again towards the 10,500 or even slightly lower, because DAX loves to stop people out, are much better value longs than longs in ES or even NQ. The same picture is apparent in the stocks. This is the stocks cash, where we could easily next week test this downtrend line. Don't forget, the European long-term rates are falling at a much faster rate, and this is the periphery I'm talking about now, than the US rates, and therefore the kick from the discounting factor is much greater in Europe at the moment. We know that our long-term system, which it was buying in these areas, is now getting out, but that's because it does money management, and that's what systems are designed to do. They're designed to take profits at higher levels. At some stage, we would definitely not be surprised to see a test of this downtrend line, which is somewhere around the next week, somewhere around the 3080 level, and then even a test of this upper trend line, which would be around the 3150. So that is a move even now of approximately 3 to 4% that you could get, which is going to be far more than any performance in ES or NQ. So your long, if that is what you wish to be, strategy should be either to be short of VXX or to be long of Europe instead, or a combination of the two, naturally. You know, as traders, we are looking for the best value. The best value at the moment certainly is Europe. We are still in the stocks, which is heavily weighted towards periphery, stocks in the EU, which are at the moment getting the biggest kick from the discounting factor. We are still trading. I mean, the beginning of the year was the price of, what was it? Well, 3,300, let's call it. So we are still here, approximately 10% below the opening price of the year. The DAX has made up that difference, and it has closed positive, and this is a huge laggard. Well, yes, there are very good reasons why it should lag, but there are also very good reasons why it should normalize at some stage, and you are buying something which is still 10% lower than the initial price at the beginning of the year, while the S&P is up 7%. So, and the DAX is now up 1%. So you are getting some value here for the risk you're taking, and it's very possible that you go and on a daily basis test this trend line, which around the 3150 area. Well, that is another 100 points, that is 3%. We certainly think that within the next couple of weeks we will do that. Thin conditions in August are conducive to a squeeze. So definitely a better buy than the equivalent in the US. What are going to be the triggers next week for any move? Well, don't forget that most of Europe is on holiday. Therefore, the conditions will be, certainly during European hours, will be very thin. So it's much easier to push markets around in smaller size. Monday Monday evening is going to be important for the Aussie dollar. We have the RBA meeting minutes, and we already know that they eased, so they're going to be hardly, hawkish. But we need to see what kind of future rate cuts they imply by the language they are using. Could be very, very significant for the Aussie dollar. We think that if it's significant, it's going to be significant on the downside and not very significant on the upside. So our risk reward going into that meeting is actually to be short of Aussie dollars, but we shall see. We shall probably not do very much until we've seen what they say. The pound has a lot of data out on Tuesday. Most of it is going to be decidedly bearish. Very little out in the States, even on Tuesday. We have core CPI. We can't imagine that it's going to be much different from the 0.2 that's expected. But if it's a surprise on the upside, bonds could start breaking down. We shall see. Certainly something to have in mind. And then we have employment in New Zealand, which is a quarterly statistic that comes from there. Very, very important to see if we have room for more rate cuts, and certainly it's going to be very important for Aussie New Zealand. Our position is now very, very small, so we have lots of room to add if this is a bullish New Zealand event. Wednesday is going to be the more important day, as we have the FOMC minutes from the state, and then again the employment change from Australia. This combination of a potentially, let's say that they do use some hawkish language, and then a weak employment disappointment from Australia could be the catalyst of the week for a lower Australian dollar. After that, we have very little. Europe is on holiday. Core CPI is going to be very flat. We would have thought 0.2. It's not going to deviate from expectations. It never does. Then Philadelphia Fed, again, we don't think that's going to move markets very much. And that is basically the end of the data for the week. So Wednesday is going to be the most important day for both Australia and the US, and could certainly shed a lot more light on dollar movements for the next couple of weeks. Just to have a look at very quickly at yields. This is the 10-year, basically stuck in a 150, 160 range. Very disappointing movements. The Bund even less. We really are on holiday. We are in basically a 5-6 basis points trading range. And Japan, which had this huge move from negative 28 to basically zero, is now slowly retracing it, and it will certainly trade at this -12, -13 area of support. And what it does there is actually going to be very significant for the Japanese yen, but also for the other yields. So while the Japanese yen bond does nothing but retrace slightly, it keeps the pressure on the other bond markets not to come a lot lower in yield. We've had a look at volatility, we've had a look at the calendar, and let's have a look at our favorite fundamental indicators of value. Here again, nothing has changed. We are hard above the slightly above the 17 times line. We see very little value in this market. Consumer discretionary has taken another move up. As we keep on saying, consumer discretionary is a much better long than consumer staples. We can't see consumer staples doing very much here, simply because there's very little room for them to appreciate. Much more room in consumer discretionaries. Energy we are leaving well alone, even though we are maybe slightly bullish for oil. We still like to see it trade towards 38 first and stop everybody out, but this is going to take months and months and months to normalize and give you any fundamental sign of anything. Financials, we are hard up against the 14 times curve, which has always held it within a couple of percent. This is, if it turns, it's going to turn very slowly. This is one fact, this is one sector which can produce a 1, 2, 3% rally from these levels, but can produce a 5, 6, 7, 8% drawdown if we get some negative surprises. Very little risk reward in being too long of this sector, apart from equal weight. Healthcare, well, nothing new here. It keeps on trucking. Certainly our favorite sector. We certainly see it trading at the highs before the end of the year. That's 900. At the moment we're around 870, so that is another 4-5%, which in relative outperformance against the S&P, we would say. Industrials, we find it very hard to do anything but trade this for 1 or 2%. This to us is an equal weight sector. We just can't get too overexcited. There is Zippo growth, and this is the area that one has to concentrate and be overweight. Technology, yes, it's going to be more volatile than the index itself, but any dip down towards this 750 area and we're going to be heavy buyers, certainly against shorts in ES. So everything else is materials, much of a muchness. We're equal weight there. Telecoms, we're actually slightly overweight here on this dip, so we are hoping that that breaks now and tests certainly the 15 times line. So we're slightly overweight here. And utilities, well, could they be telling us that there is something brewing in the bond market? We hope. We're not so sure, but we certainly hope that the long awaited correction in the bond markets can get started at some stage. Certainly Wednesday is going to clarify things up a bit, we hope. But that's about it. Remember, the Europeans are on holiday and conditions are going to be very, very thin during the mornings for the next couple of weeks. So let's be careful out there. We shall be tweeting everything that we do, and certainly we are sellers of front month volatility. So after Wednesday, that'll be the part of the curve that we'll be selling on any bounce in the index. We see very little downside at the moment in ES, therefore any rally in these front 2 months, which are September and October, we feel that are certainly a sell. And if you don't like being naked short of them, get long of some December against it. It'll certainly that is certainly still moving, i.e. long December and short of these Septembers and Octobers is still moving at roughly 10 ticks per day in your favor if you're short of the September and October and long of the December. So that's because of the shape of the yield curve. You are basically picking up 10 ticks per day, and over the course of a couple of weeks that sure mounts up. So that's still our favorite trade at the moment. Anything else that we can see or which is fundamental or macro, we shall certainly tweet to you. Thank you very much indeed.